And joining us now for a closer look at today's market developments is Cremen from AdviceWorx. Caroline, thanks so much for your time this afternoon. As I mentioned, fresh tariffs on the table, or threats of tariffs on the table. I mean, what's new here? We literally sleep and we hope nothing changes when we wake up. And here we are waking up to news of threats on pharmaceuticals as well as the semiconductor industry. How are markets reading this? I feel like it's another case of taco trade. We're just moving right along.
Yeah, we just move along because, there's not, you can't actually see which way it's going to land and then, how it's going to land and how it's going to be implemented. So I think we just have tariff fatigue and the market takes it, as it comes, when these things are finally implemented, then the market actually tends to react. I think it's something that we have expected because, when the initial rounds of tariffs were announced and then the round after that and then, all of those different iterations that have happened, they did say clearly that semiconductors and pharmaceuticals were not included, that was something that they were going to address a little bit later. And the reason why they're going to address it a bit later, because these are, if you just have a look at pharmaceuticals, this is actually a very complex supply chain. Most of the big pharmaceutical companies do have manufacturing facilities in the US.
Yes.
But, it's not, but they might not have all their drugs manufactured there, or they might just have some of the components of the drugs, the inputs of the drugs manufactured and coming in. So how do you actually implement it? So I presume that was why it was left till a bit later. But I think probably the fear is that it's just going to be very heavy-handed and not a lot of logic there. On the semiconductor side, it's quite interesting because not all semiconductors are the same. You quite possibly want to have the more technologically advanced things produced in the US. Things used for AI and self-driving cars, and that's already been done. Taiwan Semiconductor is building a very big plant in the US, and a lot of these big guys are doing it. But you really want the ones that are, that go in your washing machine and things, all those little arbitrary, your child's toys. Those things can be produced at scale way cheaper outside of the US. So why do you want to snap a tariff on it? Not logical, but we'll wait to see where it lands.
Yeah, we'll wait to see, Caroline. In company news, Novo Nordisk seems to be losing market share in the weight loss drug market, with Wegovy contending, of course, with Eli Lilly and other copycat weight loss drugs. What have you made of those numbers and the commentary that has come through? I mean, that share price has really underperformed this year, right? Is that still your pick, or would you in that sector, or would you rather go with an Eli Lilly?
So I think you can go with both. I do think Novo has probably been oversold. I think they've gone through a management change. I do feel that they kind of kitchen sink the results, made it look really, really bad. So this is still, and yes, there was an initial rush into these diabetes drugs, in fact, the anti-obesity drugs, and probably pushed the market. The market ran a little bit ahead of itself. I think that market has normalized now. That doesn't mean it's not a massive, massive industry, and that these drugs also have secondary impacts on a lot of other kind of obsessive behaviors. So I think, Eli Lilly obviously appears on the surface of it. We'll wait to see where the tariffs land. It's obviously going to be the better option because, you want to be in the US and that's where Eli Lilly is based. But certainly the price that Novo is trading at now, and the fact that it's right-sizing its business, probably at the bottom of the cycle of this, and also that they are taking legal action against some of those copycats,
yes,
as they're entitled to do. And I think that, so I think it's at the bottom of the cycle. I can't see how much more bad news there can be. Although let's probably wait for tariffs before we start to dip our toes back in there.
And I'm looking at the graph right now, and Caroline, it's not looking good. So I really do hope it's a normalization period, and that no more bad news can come through from this point. Let's cross over to the mining sector with diversified miner Glencore out with numbers today, slipping deeper into the red. Net debt also increasing. They've pointed to issues around lower commodity prices, particularly in coal, right? What have you made of those numbers? Man, not looking good. I think the share price down 5%.
I know. So Glencore, unfortunately, has a double whammy. It is a commodity producer for the most part. It is a trading arm as well. So, if you're a commodity producer and you see it in Billiton and Anglo and all of these other diversified miners, when the prices are down, the company doesn't do down. There's no logic. There's no anything strange there. So one would expect. So you just have to say, well, where are we on the cycle of those commodities? And I think we're also again probably pretty much at the bottom. Unless we have an enormous slowdown in the second half of the year as far as global trade and things go. And I don't necessarily think that's going to be there. That said, I don't think the debt is unmanageable. And they did actually make the point of saying that in the second half they are actually going to, they see that being a bit better. And then they're doing a lot of buybacks as well. So clearly they're not overly worried about that. I think the thing is also Glencore's coal. So a lot of sentiment is kind of against that. So it's not a fashionable stock. It's never going to be a fashionable stock. But I think what a lot of people were looking, people looking for ways for this value to unlock. So are they going to offload their coal business, make it look a little bit better from its basket and from its offering? That's quite possible. But I think what was really interesting for me coming out of this was that they've now forgone the US listing. And I think this is also one of the things people looked at as a value unlock, have it listed in the US. But why did they do that? And they don't actually specify. And I think it's quite interesting. It may very well be with the fact that, they did say they said it's kind of more expensive, not necessarily good for the shareholders. But, do tariffs have a bit to do with it? Is the US, maybe the US is now not looking as if it is such a great place to list your companies anymore with all of the uncertainty there. And this might very well be one of the first large knock-ons of companies not going to the US market because of all of the uncertainty that is the Trump regime.
Yeah, and I was about to highlight that the uncertainty that's at play, you just never know what's coming out from President Trump and how that might impact that economy and the global economy as a whole. Quilter, in the meantime, their numbers are quite positive, a big difference from what we saw playing out in Glencore. Its affluent and high net worth segments both outperforming its market peers, and we are seeing assets under management up 6%. Just your analysis on those results?
I think they're really great, and it's nice when a company actually surprises itself. And what Quilter actually said is that their net flows were even above internal expectations, £2.1 billion in the second quarter. That's nothing to be sneezed at, especially in an environment where it is all over the place. And I'm wondering also if maybe they're not benefiting from that, because it is such an uncertain environment, probably, because they're a financial planning advisory business for the most part. Is that people saying, listen, in this type of environment, with everything that's happening in the US, the UK, especially, the tax changes that are happening in the UK, that we maybe need professional advice.
Yes.
And that might actually be, a very, very nice tailwind, because I think things in the UK are probably just going to get worse from that perspective. They might have a lot more business.
Yeah. Makes sense. People trying to figure out where to put their money, right?
Absolutely, yeah.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on what counters your industry peers are watching closely.
Bank of Safety again has redefined properties listed locally, property company. It's not, shall we say, the one that stands out as the best managed or anything like that. But I think at current prices, and considering that we are seeing an inflection point as far as their industrial properties are concerned and their retail properties, office is possibly still lagging a little bit, but at current valuations, I think even with the expectation of steady income growth and a steady dividend policy, as far as we're concerned, we've got about a 15% upside in the share price and underpinned by about an 8% dividend yield. That's not a bad return in an uncertain market.
I'm picking a equipment rental business, United Rentals. It's the biggest equipment rental business in the world. They have almost 2,000 outlets that they rent things like scaffolding and excavators and forklifts, porta potties, generators, anything you can think of. And their main clients, it's roughly half construction and industrial users. And with the US economy doing strong, a lot of construction activity, I think a company like United Rentals can do well. They only have 15% market share, even though they're the biggest player. It's a very fragmented industry, which gives them a long runway for growth. And it's not trading at too high a valuation, while a lot of other US stocks are. So for me, it's one way to still get exposure to the strong US economy, but in a share that's still trading at reasonable valuation levels relative to a lot of other US listed shares.
So Rika's going with Redefine Properties, and JP giving us some homework, making us do a little research with his pick, United Rentals. Just your analysis on those counters.
Yes, so Redefine, and maybe I'm just a little bit prejudiced against the South African property sector. It was actually the best performing sector. It's the quarter ending June, and they're really coming for low base. And they can probably run a little bit more. Yes, I like the industrial properties of Redefine, but I find it very difficult to love South African property. I must be honest here. I think I think their yields are probably steady, but from a growth perspective, I just don't think it's there. I don't think our economy is that great, so I would stay away. On United Rentals, that was really interesting, and very very fantastic, a really nice company. Did some homework on it, and. Yeah, he's quite correct. It's a very fragmented market. So, you even see it in South Africa, your tool high, you used to get from anybody, but now when you're going to hard stores, there's one or two names. So this is the same type of thing. And also it's working for businesses and small, people like you and me who want to go higher tools. So I think really nice business, but it does always, I kind of disagree on the valuations. I think it depends what type of growth you pop in there. That it's either a fully priced stock or it's a cheap stock.
Okay.
I'm probably more on the tending towards fully priced, because I think local players, where they are entrenched and you want to take over their business, will be very difficult to do because they have long-term relationships with with builders and things like that. But still a fantastic company, really really nice. I'll keep an eye on that now.
All right, so you do somewhat like that one, but that's not your stock pick. Where are you seeing opportunity at the moment?
Okay, well, it's not for everybody, but I'm getting a lot of client queries about this. And now this is an exchange-traded fund. It is called the Future of European Defence Fund. Its share code is NATO, N-A-T-O, so it's impossible to forget. Now, it really is based on the fact that, all the NATO countries being pressurized by a certain president who shall remain nameless to up their defense spending. By the year 2035, they need to be spending 3.5% of the GDP on physical defense systems and an additional 1.5% on non-physical. So these are your cybersecurity types of defense companies. So this particular exchange-traded fund invests in those companies globally. So you're going to get within this fund, you're going to get something like a Palantir, you're going to get CrowdStrike, you're going to get the Raytheons and also Grumman's, BAE, the industrial defense stocks. And, it's just there's just so much expenditure coming. If you can get that at a nice price and just hold it, you're probably going to do rather well, those companies, over the years to come.
And quickly before I let you go, with that being your pick, what do you think of Sirius's play on, gaining on defense and defense spending?
Yeah, that's the distance, or the intellectual distance, or the tech distance between gaming and tech has always been very narrow. We know that a lot of these drones and things kind of their operating systems are really direct copies from all of the advanced gaming that we've had in the past. So where gaming went first, defense has followed. So. And it's probably going to become more and more relevant as time goes on. So the question is, do you want to invest in gaming or do you want to invest in defense? And I think the line between the software of a lot of those companies is becoming increasingly blurred, actually.
All right, let's leave it there, Caroline. Thanks so much for your time and sharing your insights this afternoon. Now, that was Caroline Cremen from AdviceWorx.